The United States Senate just passed the Genius Act, the first ever federal law that tells dollar-pegged stablecoins exactly how they have to behave. If you've never played with crypto in your life, that might sound a little bit like Silicon Valley chatter, but this bill could soon affect where you park your emergency fund, how you pay your mortgage or rent, and even what interest rate your cash returns. Imagine opening your Charles Schwab app and right next to the money market fund button, you start seeing a new option labeled USDC, same day yield, dollar backed, withdraw anytime. Or picture paying online for a hotel room, and the checkout page accepts stablecoins that settle instantly and they don't have that 3% credit card fee. That feature just went from maybe someday to probably next year. And in the next 10 minutes, I'm going to show you exactly what the new stablecoin bill does and why Wall Street and Main Street both care. By the way, if you're new to the channel, welcome. My name's Tom Polifka. I'm here every week trying to translate Wall Street jargon into plain English so you can make smarter money moves without needing a finance degree. Even though many people with a finance degree still don't understand stablecoins, and that's okay. We're going to get into that. I want to make you aware of what's possible and give you the clarity to decide whether regulated stablecoins deserve a spot in your cash strategy. No hype, just facts that you can act on. A dollar stablecoin like USDC is basically a digital cashier's check. For every token on a blockchain, there's supposed to be one real dollar or $1 worth of treasury bills sitting in a bank account. Because blockchains run 24/7, stablecoins let you send money, just like I said, at 11 p.m. on a Saturday or Sunday night and settle in just seconds instead of days and maybe potentially even a full week, depending on when the banks are open. Stablecoins have exploded from roughly $28 billion 4 years ago to more than $165 billion today. But until now, the regulatory landscape was anything but friendly. Some issuers used state money transmitter licenses, others hid offshore, and disclosures ranged from a monthly PDF to radio silence. Recently on the All In podcast, David Sachs, the crypto and AI czar for the Trump administration, recently shared what led up to this bill being passed.
Well, it's definitely something we supported, and this is, I think, a huge milestone. I mean, just what basically happened is we had this Genius Act, which is the stablecoin bill, passed the Senate with 68 votes, got 18 Democrats. They came on board. We had to hit that key threshold of 60 votes in the Senate. That's the threshold you need in the Senate, unless it's a narrow exception for reconciliation. So it's very, very hard to pass any bill out of the Senate, and you need a significant amount of bipartisan support. And we got that. Now, when you consider where we were a year ago, you realize what huge progress this is for the crypto industry. A year ago, you had crypto companies being prosecuted. You had this whole regulation through prosecution approach where Gary Gensler, who was the chair of the SEC then, he wouldn't tell startups what the rules were, but they would just announce prosecutions. And this was driving all the crypto innovation offshore. And I think we were basically poised to lose the crypto industry in the United States.
Fast forward to June 17th, 2025, the Senate passes the Guiding and Establishing a National Innovation for U.S. Stablecoins Act, the Genius Act for short, in a 68-30 bipartisan vote. Here are the 4 rules that matter. Rule number 1, full reserve mandate. Every token must be backed 1-for-1 by cash, Federal Reserve deposits, or short-term treasury bills maturing in under 90 days. Rule number 2, monthly transparency. Issuers must publish an independently attested reserve report every 30 days, breaking down exact cash and T-bill holdings. Rule number 3, big dog audits. Issuers with more than $50 billion outstanding, think of Circle or Tether, must file a public GAAP audit once a year. A GAAP audit is an independent examination of a company's financial statements to ensure they comply with generally accepted accounting principles, or GAAP. This involves a thorough review of financial records, transactions, and internal controls to verify the accuracy, completeness, and fairness of the financial reports. It enhances the credibility of the financial statements, making them reliable for investors, creditors, and other stakeholders. Rule number 4 is a federal PSI Charter. PSI is Payment Stablecoin Issuer License that lives at the Office of the Comptroller, or OCC. Firms under $10 billion can opt for a state regime that mirrors the federal rules. So why should ordinary investors care? Well, safety first. Token holders leapfrog shareholders if an issuer fails, giving you near deposit protection without being a bank account. Yield opportunity. 1 month Treasury bills yield about 4.8% right now. Let me ground that in numbers. So parking $25,000 in a 1% savings account, and you'll earn about $250 a year. If you move that cash into a regulated stablecoin platform that's sharing 3.5% of Treasury yield, and you earn $875, that's a weekend getaway or an extra mortgage payment perhaps, just by choosing a better wrapper. But it doesn't sound like consumers will be able to take part in this shared interest quite yet, according to David Sachs on the All In podcast.
The way the framework works is that the stablecoin issuers cannot pass on interest to the token holders.
Why is that?
Look, I mean, I don't know if there's a great principled reason. This was a compromise that was necessary to get the support of the banking industry, quite frankly.
They see it as competition, I'm betting.
Well, there was a lot of concern from community banks that if stablecoins were paying 5% interest, it would put them out of business. I think that concern, although understandable from them, I don't think that that's what would have happened. But these are the types of compromises, quite frankly, that you need in order to pass legislation. I hope that at some point in the future, we'll revisit that and allow stablecoin issuers to kind of just do what they want to do.
Faster money moves. With clear anti-money laundering rules, banks can integrate regulated stablecoins directly. So transferring $5,000 at 10 p.m. on a Saturday night could settle in 30 seconds instead of Monday morning. Then you have tax clarity. The House companion bill proposes a $600 de minimis gain exclusion up from today's $200, making everyday spending simpler. This de minimis gain is basically the tax you pay on gains from the sale of the underlying bonds. Then there's portfolio flexibility. Regulated stablecoins can act like a modern money market fund, instant transparent, and potentially higher yielding. Let's look at the fine print in this new law. There are some legislative hurdles. The House still has to pass its version and reconcile any language that might be a discrepancy from the Senate. There are some privacy trade-offs. Issuers must follow the Bank Secrecy Act. Large transactions will be reported. Then you have market concentration. Compliance costs favor the giants like Circle or PayPal and may squeeze out smaller innovators. Now, zoom out for a second. Why is Treasury Secretary Scott Bessent so vocal about this bill? Because it quietly hands him a brand new way to fund Washington's record-sized deficit without hiking taxes or begging the Fed to buy more bonds. Here's how the math works. Rule 1 of the Genius Act forces every regulated stablecoin to hold its reserves in cash or ultra-short U.S. Treasuries. Circle and Tether already park roughly $166 billion in T-bills today. Morgan Stanley estimates that once the law kicks in, aggregate reserves could balloon to $1.6 trillion within 2 years, as global payment apps, brokerages, and even payroll firms mint their own coins. For perspective, the entire publicly held national debt grows about $1.5 trillion each year, so stablecoins alone could absorb an entire year's worth of new issuance. Bessent framed it bluntly in his CNBC interview.
I think it's the opposite.
Oh, really?
I think stablecoins could reinforce dollar supremacy, because with stablecoins could end up being one of the largest buyers of U.S. Treasuries or T-bills.
Mm-hmm.
So all of a sudden, if you are using a stablecoin in Nigeria that's backed by the U.S. dollar, you don't actually have to have dollars. It's on your phone. You can transact. So I think there's a very good chance that crypto is actually one of the things that locks in dollar supremacy.
T-bill demand matters because bills are rolled over every few months, letting Treasury plug short-term cash gaps at lower yields than 10-year notes. If issuers drive bill demand high enough, auction yields could dip 5 to 15 basis points, saving taxpayers billions of dollars, according to a Bank of America fixed income desk note quoted by Reuters. Critics argue it's just shifting money from money market funds to stablecoins, not creating brand new demand. But Bessent counters that stablecoins attract international savers who previously sat in euros or yuan, effectively importing foreign capital into treasury auctions. CoinGecko's 2025 RWA report backs him up, showing on-chain tokenized Treasury holdings have already quintupled in a year, with 60% of wallets geolocated outside of the US. There is a flip side. If confidence in a mega issuer wobbles, they'd have to dump T-bills fast to meet redemptions, potentially jolting short-term rates. Bessent says the monthly reserve disclosures and OCC supervision give him early warning radar to intervene. Bottom line, in Bessent's playbook, regulated stablecoins are digital sponges that soak up fresh Treasury supply, keep borrowing costs tame, and reinforce the dollar's dominance at the same time. Love or hate crypto, that's a funding lever no Treasury Secretary has ever had before, and it's why this bill matters far beyond the blockchain crowd. Let's look at the bigger picture. Opponents argue stablecoins might drain community bank deposits, but a Bank Policy Institute research note modeled a 20% deposit migration and found aggregate liquidity coverage ratios would fall just 40 basis points. Treasury-backed tokens also keep cash in treasuries, so Uncle Sam still gets the money. Multiple studies show that when households feel safer, they spend more money steadily because they're less anxious about emergencies, smoothing overall GDP swings. Here's a quick recap. The Genius Act enforces one-to-one reserves, monthly disclosures, annual audits, and a new federal charter. For beginner investors, that means safer digital cash, yields that can rival money market funds, and instant transfers, and simpler taxes. If you enjoyed the video, hit the like button, share this with a friend who thinks crypto is all the same, and subscribe to the channel if you want to see more of this content. If you found this video interesting, YouTube thinks you'll love one of these two videos next. Have a great day, and I'll see you next time.